Welcome, class. Go ahead and take your seats. I'm your professor for today's masterclass session, and together we're going to thoroughly master the sometimes tricky, complex rules of fixed and biological assets. We're going to be strictly applying the latest Vietnamese accounting standards, specifically looking at Circular 99, which is applicable for 2025 and beyond. Now, as future chief accountants and financial controllers, the concepts we're covering today are literally the absolute bedrock of your balance sheet management. So grab your notebooks, get comfortable, and let's get started. Okay, let's dive into this. Here is our syllabus for today. First, we'll cover fixed asset fundamentals. Then we'll look at determining initial costs, tracking asset changes, and distinguishing repairs from depreciation. After that, we'll explore biological assets, and finally, we'll wrap up the whole shebang with financial statement presentation. This logical flow is going to make these dense regulations incredibly clear. All right, starting off with Section 1, Fundamentals of Fixed Assets. Before we can calculate any numbers, we absolutely must establish the legal framework and core definitions. Now, I really need everyone to memorize these 4 specific criteria derived from Circular 45. For an item to be recognized as a fixed asset on your balance sheet, it must meet all 4 of these conditions simultaneously. Not 3, all 4. First up, it has to generate future economic benefits. Second, its cost has to be reliably measured. Third, its estimated useful life must exceed 1 year. And crucially, this is the big one. Fourth, its value must be 30 million Vietnamese dong or more. If it fails even one of these tests, there's no way it can be capitalized as a fixed asset. It just becomes an expense or a tool and instrument. Let's test your understanding here with a quick Socratic question. Imagine your company buys a high-end laptop for 28 million VND. The manufacturer guarantees a 3-year useful life. So, is this a fixed asset? Think about those 4 criteria we just covered. Have your answer? Well, because it comes in right under that 30 million VND threshold, it completely fails criterion number 4. Therefore, it is classified as a tool or instrument, not a fixed asset, and its cost is going to be systematically allocated to expenses, rather than capitalized into account 211. Now, once an asset actually meets those 4 criteria, we have to classify its nature, and this brilliantly illustrates the strict division in our chart of accounts. Tangible assets, those go in account 211, are things you can physically touch, buildings, transport vehicles, heavy machinery. Intangible assets, on the other hand, go in account 213. These hold massive economic value but lack any physical form. We're talking software licenses, patents, and permanent land use rights. Mixing these 2 up is a massive error in your reporting, so keep them straight. Moving right along to Section 2, Determining Initial Cost. Let's look at how we calculate the historical cost upon acquisition. Listen, getting the initial cost right is quite possibly the most critical step for any accountant. Why? Because an error here is going to carry forward for years through incorrect appreciation. The golden rule of initial cost, or historical cost, is that it includes all necessary costs incurred to bring the asset to its ready-to-use state. So if you buy a factory machine, the initial cost isn't just the sticker price on the invoice. You have to capitalize the shipping fees, the installation costs, and even the trial run expenses. However, and this is a big however, we strictly exclude refundable value-added tax, general administrative overhead, or any abnormal waste during setup. All of those, they go straight to the income statement. Okay, let's look at another practical scenario. Let's say you've had a machine running on the factory floor for 6 months. Suddenly, out of nowhere, it requires a 15 million VND repair due to a manufacturer defect. Do you add this 15 million to the initial cost on your balance sheet? The answer is absolutely not. Why? Well, because the asset had already reached its ready-to-use state 6 months ago. Therefore, this post-acquisition repair is strictly treated as an operating expense in the current period. It's not capitalized. Now, in actual accounting practice, theory has to meet documentation. What we're looking at here is Form 01, the official fixed asset handover record. Before any asset is officially put into use and registered in your ledger to begin depreciation, this specific legally mandated handover record must be completed. It has to be signed by both the technical and receiving departments. Without this piece of paper, your journal entries have absolutely no legal backing. That brings us to Section 3, Accounting for Asset Changes. We're going to track the life cycle: acquisitions, liquidations, and transfers. When an asset finally reaches the end of its life, or maybe it's sold off, we perform a liquidation. Class, I want you to write down these 3 chronological steps. Step 1, we have to clear the asset from the books entirely. We credit account 211 for the original historical cost, and we debit account 214 to clear out the accumulated depreciation. The difference between those two is the net book value, which gets expensed. Step 2, any costs incurred to dismantle or transport the scrap are debited to account 811 as other expenses. And finally, step 3, any cash you actually receive from selling the scrap is credited to account 711 as other income. Just like the acquisition phase, liquidation requires incredibly strict documentation. This is Form 02, the official liquidation record. You have to have a designated liquidation committee sign off on this document. I really want to emphasize this to all of you. Without the authorized signatures on Form 02, those 3 journal entries we just walked through cannot be legally posted to the general ledger. In our world, documentation is everything. Next up, Section 4, Repairs and Depreciation. Here, we distinguish everyday maintenance from actual capitalization. So the crucial point here is understanding the true economic impact of the work being done. Routine repairs, we're talking about changing the oil in a delivery truck or repainting a factory wall, simply maintain the asset's current condition. These costs are expensed immediately to the profit and loss statement. However, major upgrades, like, say, installing a brand new robotic arm that drastically increases production capacity, or replacing a massive motor that extends a machine's life by 5 years, those create new future economic value. Therefore, these costs are capitalized. They flow through the work in progress account 241 and ultimately increase the assets value on the balance sheet in account 211. And of course, there's a form for that. When a major upgrade is finished, those costs have been quietly accumulating in account 241. The signing of Form 03, the handover record for repairs and upgrades, is the exact trigger event for you, as the accountant, to capitalize those accumulated costs into account 211. This officially increases the base for all your future depreciation. Speaking of depreciation, the core matching principle dictates we allocate the asset's cost over its useful life. However, under VAS, there are a few strict exceptions where we do not charge depreciation to manufacturing costs. Mark these down. If an asset is fully depreciated but still running, you stop depreciating. If an asset is lost or destroyed, you write it off entirely. You don't keep depreciating it. Assets used purely for employee welfare, like a company gym, do not hit production costs. And finally, land use rights with an indefinite term are never depreciated because land, theoretically, never loses its economic value. All right, let's shift gears completely to Section 5, Biological Assets Accounting. Let's dive into understanding account 215. We are moving into a highly specialized and honestly fascinating topic under Circular 99, biological assets. These represent living plants or animals that a company controls. Now, dealing with living things requires a completely unique life cycle accounting approach. Instead of buying a machine that's ready to use on day 1, we are accumulating the daily costs of feeding, vaccinating, and growing livestock or crops over time. All of these operational costs are gathered under account 215. We track the asset continuously until it finally reaches maturity and is ready for harvest. Now, what's really interesting here is how the ultimate purpose of the living asset changes its accounting treatment. A mature dairy cow yields milk periodically over several years, right? So it acts much like a factory machine, and because of that, it is depreciated over time. Conversely, a meat pig yields its product only once. Therefore, it is not depreciated. Its accumulated costs are simply treated as inventory and expensed to cost of goods sold upon harvest. Seasonal crops like corn follow that exact same one-time harvest logic. Okay, I need everyone to pay very close attention to this next critical point, because this is a massive trap in both your exams and in real-world practice. Despite being living things, perennial trees, like a rubber or coffee plantation, and working animals, like draft horses or plowing water buffaloes, do not belong in the Biological Assets Account 215. Under the regulations, they are actually classified as tangible fixed assets under Account 211. They behave identically to factory equipment in the eyes of the law. Do not mix these up. Finally, we reach Section 6, Financial Statement Presentation. How to ensure proper disclosure under TT 99/2025. So we've done all the hard work of calculating and journalizing. Now we have to present this reality accurately to the public and to our auditors. Presenting just the net book value on the face of the balance sheet is simply not enough. Your footnotes must transparently reveal the real story behind those numbers. You are mandated to disclose your depreciation methods, whether you use straight line or declining balance. You must provide a full reconciliation of all changes in historical cost. Critically, you have to disclose if any of your assets are tied up as collateral in bank loans, and you must list assets that are fully depreciated but are miraculously still generating value for the company. To conclude today's session, I want to leave you with this provocative thought. Imagine your company owns a fleet of delivery trucks. According to our rigid historical cost accounting rules, their net book value is absolutely zero. Zero. Yet they're out on the road every single day, operating efficiently and generating massive cash flow. So, how does this accounting reality impact the true economic valuation of our business? Does the balance sheet truly reflect reality at that point? It's something to think about. Keep questioning the numbers behind the business class. Thank you all for your attention today, and I will see you in the next session.